Hey, welcome to Super Stock Bros. My name is Ace, and today we're going to be talking about the economy and looking at the ARK report that came out recently, which Kathy Wood made a video on, and also taking a look at the SPAC portfolio update. So stay tuned. Alrighty, first up, let's look at our portfolio. I did have a chance to update it. I put in the CCIV warrants and the 50% loss, for which I moved out the warrants. I didn't sell all of them, but I sold most of them, and I wanted to move it out because this is the swinger portfolio. Yeah, it was a big loss, but no worries. It happens, especially when the market takes a huge downturn as it did. It really compounded on top of CCIV's ultimate betrayal of the stockholders. So that's unfortunate, but we can recover from it. Okay, so next we are talking about the SPAC Road to a Milli SPAC warrant bullet, which is, the real challenge. We're still on the first bullet, and that has not changed because IPOF hasn't found a merge target, and neither has IPOD. So I'm waiting for one of those to happen, and in the meantime, we'll wait patiently. So not moving on that position. Alrighty, and as you can see, it's about the same price that we bought it for, so nothing has really changed here. And in terms of the swing portfolio, yeah, it's about what I said before, which is we traded the CCIV warrants and then we switched to the IPOF warrants. So we're still on that. Now, a lot of things have happened in the market that made me want to switch out of these warrants, I'll tell you that much, but we stayed in them. We want to be consistent with the strategy while giving as much information to you so that you can make your plays. So what plays are we looking at next? First, I wanted to talk about the economy in general and give a little bit of a summary of what Kathy Wood was saying in her recent YouTube video, which I shall link below. So first of all, we're talking about the Fed support, and everyone wants to know, is the Fed going to support the economy? What are they going to do going forward? And basically, Jerome Powell's main goal was to focus on full employment, okay, and focus on the inflation rising back up to normal levels. They want it to be consistently at 2%. Now, this is the same thing that they've been talking about over and over, so that's fine. Sticking to the same story, and that's commendable that they want to get to full employment. It's a good goal. The question is, how are they going to do that? And we'll see, because now markets are pressuring to make a different reaction here. Okay, so next up we are talking about the commodities and assets, and I've mentioned this in previous videos, but commodity prices are moving up very rapidly, especially copper, wood. So and on top of that, it's a double whammy because the dollar is coming down, so that basically means that things are more expensive. The dollar buys less, right? So not only commodities is going up, but now the buying power is less, and therefore you get cost of doing business is way higher. Okay, so this is case in point, inflation here, right? So what is happening as a result? Housing prices are moving higher. The market is indicating, because of all these things moving up, that there will be a Fed response soon. Now, what does that mean? Usually the market leads, so it has some kind of, dreadful effect, where it drops 10, 20%. And then the Fed has to step in and say, hey, look, these things are getting out of control, and we'll do something, whether that be buy corporate bonds or something like this. So people are still waiting on a Fed reaction, and actually it was priced in at the very start of this week. Monday, the equities market came back up, bond yields fell a little bit, and I think they were pricing in a possible Fed reaction. But nothing has happened yet, and bond prices haven't fallen too far. It's almost stabilized at 1.4%. So what does that mean? That means that we might still be seeing some turbulence coming up ahead here. Next up, consumer spending with the economy here. So what is that? That stimulus package. Kathy Wood talked about how, yes, there's going to be that $1.9 trillion stimulus package, and that excludes the $15 minimum wage. So that means that there's another $3 to $4 trillion on the way. So of course, pumping all this money in, that's going to lead to more inflation here. So other things that are very interesting, the disposable income was up 11.5% month to month. Spending was up 2.4% month to month. Now, what does this mean? That means there's a lot of capital spending, and because housing is strong as well, that means that there's a lot of money going around. Okay, next up is a fear in the market. Okay, so traders have been shorting the bond market because of the bond yield is rising, and the bond market is being shorted at a record rate because the yield is rising so much. Because as the yield rises, the bond prices fall, and that means that people are going to keep shorting it because they expect the bond yield to keep rising because they expect interest to rise because of inflation. Okay, so that means that there's volatility in the bond market, and it has outpaced the stock market, and that's what we saw last week with the crazy increase in the bond yields. I showed the chart in one of my other videos, but essentially it went from 1% all the way up to 1.6% in less than a month. Basically, that means that people should really pay attention to this. This is warning bells going off, and the Fed should pay attention. And everybody in equities might be shifting around their money because now that bond yields are so high, now this is better for safe money. Like if you have $1 trillion, you're going to be wanting to go into these safe guaranteed bond yields as opposed to staying in the risky market, for example. Okay, so what does that mean? Well, that means that the market is reacting very strongly to opposing quantitative easing. The value is being shifted around the entire market as opposed to being concentrated on just innovation, okay? Which Cathie Wood actually views as a good thing, because when you have too much of a concentration in innovation, you have something like what happened in the dot-com bubble where people kept investing in these things that were half-baked, okay? And what that led to was this gigantic bubble that eventually burst when these companies couldn't deliver, they weren't delivering profits, and the money was just sitting there in these companies doing nothing, essentially, for example. So it's good that it actually broadened out to the whole market, Cathie Wood says. Now, what she didn't say is that this isn't really good for ARK in the short term, but she did mention that this is definitely good for ARK in the long term. And if it's good for ARK, that means it's good for these innovative stocks that we love to invest in. And actually, Cathie Wood referred back to 2017, where this type of thing actually happened. And what happened was that this was a very strong year for the equities market. Okay, now in terms of crypto, this is something we don't really talk about on the Super Stock Bros a lot, although we do mention it in our Discord channel, and we do actually have a couple other channels with it. So Janet Yellen, who is the United States Secretary of the Treasury, went out of her way to telegraph how speculative crypto is, Bitcoin in particular. And she doesn't really understand crypto too much, but the thing is, I think she's mainly saying this because of how fast crypto has grown over a short period of time. Now, this might be a red flag for crypto in the short term because they might have the SEC send out warning messages or send out investigations, etc. So that's something to be careful of. But Cathie Wood actually had a funny anecdote where she talked to like an FBI agent, and this FBI agent said they love crypto because, first of all, the FBI is filled with cryptographers already, and secondly, the blockchain has IP addresses and everything like this, so you can actually track back to the crypto holders. So that's interesting. I mean, obviously that's not 100% true, but I'm sure that the FBI has methods of doing this. Now, another thing is, obviously, ARK, if you've been following them, has mentioned that trillions of dollars could be poured into Bitcoin from various corporations. And they mentioned that if they got, even a small number of companies that are on the market to invest in Bitcoin as like a cash reserve, for example, then Bitcoin could go as far as 500,000 or even $1 million. So, I mean, that's crazy to me. I don't know how far out that is. That seems like it's going to take a long time to adjust to, even though Square and PayPal and Tesla are leading the way in that regard, which is very interesting to me. And another thing she mentioned is, hey, look, let's just think back to what Bitcoin is actually helping to do, which is solving a lot of the financial problems, pen and paper, or just long wire transfers. And Bitcoin, although it does consume energy, this is a main argument against Bitcoin. Hey, it still consumes energy, so what are you talking about? Yeah, I mean, but it still only costs like $10 a transaction for all of the energy costs incurred. Whereas if you compare the cost of like doing a wire transfer and the staff, etc., that is actually incurring a large amount of energy costs in the real world as it is today, up to $1 million even for a simple wire transfer, for example. Okay, now onto the part that I found the most interesting was interest rates. Okay, so as interest rates have fallen, Cathie Wood mentions that PE ratios should have gone up. Okay, they always seem to top out at around 20 to 25 times. Okay, so most companies have a PE ratio of 20 to 25, and that seems normal to us. But this only applies a 4 to 5% interest rate, because if you take 1 divided by 20 or 1 divided by 25, then you get 5 and 20 and 4%, right? So, but the thing is, obviously the rate is much less than that. So the equities market hasn't even priced in 1 to 3%, right? You've only priced in 4 and 5, for example. So valuation support should technically be at around 33, 50, or even 100. Now, this is very interesting, because that means that she's applying that, yeah, the stock market is actually poised to rise much higher if the interest rates stay around the same level. And I mean, even Powell says that they're aiming to get it around 2 and then maybe 3 in the future. But still, that means that the market hasn't priced in such a large move, and that is bound to go up even higher. So, I mean, obviously we know that stocks only go up, but the thing is here, it's good to hear this from a mathematical perspective. Kathy went on to mention something about deflation, and how it's always good to think about, everyone's always thinking about inflation, and how, because the dollar, you keep printing money and inflation is just naturally occurring year over year, which obviously makes sense. But the thing is, she will argue the defense of deflation, right? And there's not only good deflation, there's bad deflation. So good deflation is technology reduces costs, and therefore you get more bang for your buck, right? So that's a form of deflation, a good form of deflation. And that's been happening, obviously. Your computer, which has such incredibly advanced parts, would have probably cost you $1 million a few years ago, but now it's only like $1,000, for example. So that's one form of deflation. Another form of deflation is the bad deflation. So this is also an interesting example, and something that we shouldn't forget about. When old companies are put at risk because of all of the debt that they've accrued, and because they're falling out of favor because they're not innovating fast enough, that means that they'll be forced to cut their prices to service that debt, right? So, say you still were selling video cards for $15,000 for some reason, and your company can only operate at that level. If you're forced to cut down to $300, well, that means you're going to be laying off a lot of staff and everything like that. So you have the good deflation versus the bad deflation, and then inflation. And she described it as waves all crashing into each other. So we're going to be seeing some interesting market moves in the near future, if not over, 5 to 10 years. Okay, so what does that all mean for you? Well, it's always good to pay attention to the economics of what's happening. You want to see the macro and the micro. If you were paying attention, for example, to the bond yields as they were rising, you might have known to either pull out at the right time, especially the speculative stocks, or, just hold on tight, as I usually recommend. Now, I wanted to conclude with a few stock picks, because we had some interesting discussions in the Discord chat, and these stocks came up. If the market dips further, it's a good idea to look into stocks that you want to buy for the long term, but I also noticed some high volatility stocks that are affected both ways. So let me just share that. Okay, so here's a list of stocks that I'm looking into to see on the next downturn if I can get at a cheaper price and ride for a swing momentum play or hold for the long term. Now, all of these solid high volatility stocks, I would love to get stuck with them, to be frank with you. So if I buy them low and I get stuck and then go even lower because of the uncertain market times, then I'm happy with it. This spec plays with higher volatility. A couple of these are crypto plays, and then you have Microvision as well as SOS and AMC, which I also do believe in the long term, but who knows in terms of the pandemic. But it's good to ride out long, in my opinion. That's what I might do. And for the SPACs, you have the Black Sky merger, you have the Archer merger, you have the Momentous merger, and then you have the Curiosity Network, which I've noticed has been actually varying very, very, very wildly. And it's good for your swings, because honestly, you can believe in that network and swing it out. Another few that you might want to watch, NEO is cheap. The earnings were kind of whatever, and the guidance was weak, but the long term is still good. So it's a long term play. It's not really a swing play, but if you can get in at this price, honestly, I like it for this price. RKT, we announced actually in the Discord chat on Monday and Tuesday that it was a decent buy in the morning, but just to be careful because it will drop after the special dividend day, which is actually March 8th. So ex-dividends March 8th, that means it will probably drop out the opening bell. I hope not. I think it's a great stock, but at the same time, it's probably going to happen. People are going to take their 5% and leave. I'm sure of it. So BRPA, I've been watching this very closely. This is the BlackRock Partners acquisition. They are handling a pharma company called NeuroRx, and they're actually taking a look into some medication that's good for relieving COVID via nasal oxygen, high flow nasal oxygen. So this is pretty interesting. It might actually get into Fed emergency approval if it's good within the next 23 days. So I'm waiting for it on March. I said 13 days here, but it's actually going to be March 15th. And we'll be taking a look at that. And then finally, I still have the IPOF warrants, and it's actually, it's been a roller coaster, but it's getting to be a really good, cheap price. And quite honestly, if all the SPACs go up, it'll ride up too. And if Chamath tweets as he usually does, then it'll usually ride up with that as well. So we'll take a look into that and see what happens. I'll obviously keep that as my main play in both my portfolios, and I'm watching very closely to invest in these other plays. So take a look, do your DD, and see what you can find, see if you want to invest in it. Okay, that's it for me, Stock Bros. I hope you enjoyed that market update and some of the stock picks I've shown you, and hopefully together we can make those gains.